Hi, my name is Edward Beck. This is financial stress testing. We're going to be using Jupyter Notebook and some Python to look at this financial event. And first we're going to download some standard Python libraries using stats models, sklearn, and plotly, the most important ones. We're going to create a quick time series, and it's going to be a little randomized and to show a generalized increase in trend over the 1,000 days or so from January of 2017 to November of 2019. And we're going to use that time series to create our asset portfolio, and we're going to put in a certain amount of capital, and we're going to divide it up doing an asset liability management, and we're going to invest in different things according to that protocol, and found some up-to-date interest rates for these, and that's going to create us a nice portfolio, and we're going to invest in some different products. That's what the time series looks like. For two of them, we'll test run, and when we look at everything all together, we can see some of the financial products do much better than others. We can see like a very slight increase, but this is in times of ideal conditions. So it's expected to see a generalized increase in our assets, and an asset liability portfolio wouldn't be anything without some liabilities. So we have our standard way of dividing up the liabilities through term deposit, demand deposits, and so on and so forth. That's gonna look like, if I can scroll down, it's gonna look like this over time. Again, we see some pay off much better than others, but they also have different interest rates associated with them. But we're gonna then just combine everything together to look at our assets and our liabilities in one big, I guess I do not show you that, but I swear it's there. More importantly, what this whole project is about is adding some stress to the system, and that's what this equity risk data frame is all about, because in times of changing stock prices or increased interest rates and all kinds of other uncertainties that the world has to offer, we need to have our assets being larger than our liabilities. So we're going to add different amounts of stress to the system. I'd kind of lower the amounts of stress, because I don't want to crash everything, because while that might be what actually happens, it's not necessarily the best thing when you're talking about a project. So here is all of our assets and some of our liabilities too, and you can see that the assets have been decreased in the amount that they're going to go up, and our liabilities, you can see that they're increasing. So what we need to do is to look at the difference between the before the stress and after the stress was implemented. So we're going to look at the spread of our asset liability portfolio, and you can see over time some financial products don't do too bad, where there's not that much of an increase due to the stress, but other financial products definitely are quite negatively affected. The higher this goes, that means the higher the spread between those caused by the stressor. Now here we have a much bigger data set that has all kinds of different amounts combined together, as well as different amounts of stress. And we're going to run through all those things. We're going to look at our assets under ideal with all these different stresses, different amounts of money, different amount of capital, and you can see that they do pretty good under ideal conditions. But when we start to uh, add some stress to this situation, we can start to see some really negative consequences for some of our financial products. And you can see the spread um, becomes quite large, and we're not doing so good. So, um, as you can see, this is the equity risk portfolio with how much the stress is going to affect um, the products over time. And it would be ideal, obviously, to relocate the capital from, say, um, commercial loans and put them into uh, broker deposits, because the broker deposits do a little bit better. They still are gaining money when, unfortunately, uh, the commercial loans start to lose money. This would probably be in times of, say, if the stock market um, tanks and we have another recession going on. And but this, all these portfolios are kind of predicting what's going to happen, like on a time series, but it's not automatically updating on a daily basis. So I made a recursive function that updates on a daily basis. Unfortunately, with the recursive function, because we're starting off with such small amounts of money and building over time, the recursive function kind of doesn't do so well. And but we can maybe, like, that has to do with the fact that the original time series that was created by me was artificial, and it was created for visual appeal, but a different time series wouldn't be increasing as much, but it also would be starting out much higher. So, like, a recursive function would make much more sense to be updating. But we're now going to kind of look at all of our data in like different lights to analyze it better. And we just see just different ways of looking at our personal loans, or just different graphs. And like, even when we start to look at the months, like, of our, you can see different patterns. Like, as in this bar graph, you can see there's a much variability in the month of October, with a slightly higher average compared to other months. And you can see that again with the variability being very great here in our violin parts. But more importantly, with time series, what we're interested in is to see if there is like a stationary aspect to it. Like, is there an average, and is there a continuous variability throughout the entire time series? Because if a time series is stationary, that means we can predict it. And as you can see, or if you recall at the very beginning, our time series went up, and there was a trend upwards, so that it's not going to actually be stationary. But if it were, you would be able to do different types of modeling. And to kind of show you this, we're going to look at a weekly mean, and like you can see this rolling mean is like slowly but surely going up. And when we have like much bigger hops all around, the 7-day average is not these nice big blobs. But this becomes even more pronounced when we go from 7 days to 30 days. And you can see this, like, these thicker lines, and that's like a 30-day average. And you can see a general trend upwards. And what we're going to do ultimately is we're going to be looking at different types of modeling. So one of the things when we're doing a mirror modeling is we want to look at the partial autocorrelation. And when we have these outliers like here and here, like when it's outside this blue area,